Well, good afternoon. Good afternoon, everybody. Welcome to the Whatcom Business Alliance Recovery Whatcom webinar series. I'm Barbara Chase, the Executive Director of the WBA. For those of you that are not familiar with the Whatcom Business Alliance, we're a nonprofit, nonpartisan advocacy group, and we all share a vision of business success and community prosperity here in beautiful Whatcom County. There are a multitude of challenges that businesses are facing right now. Business owners don't have time to stay current on the thousands of rules and regulations being created at the federal, state, and local levels that may harm their business. So in an effort to keep Whatcom County business informed of the latest developments, we've conducted our regular Recovery Whatcom webinar series. We really are the eyes, ears, and voice for Whatcom County business, and we believe that business success is the single largest driver of community prosperity, which is why we focus our efforts on facilitating that success through advocacy, research, education, and job opportunities. So today we have a team of tax experts that are going to be presenting the latest information on what to expect in 2021 and beyond. So thank you to Moss Adams for sponsoring this webinar on President Biden's new tax laws and how they may impact your business. I'd like to introduce Todd Kooiman from Moss Adams. Moss Adams is headquartered in Seattle. They are the largest accounting and consulting firm in the Puget Sound region, and they have locations in Bellingham, Everett, Seattle, and Tacoma. Their full range of services includes accounting, consulting, as well as individual and institutional wealth management. Moss Adams is dedicated to assisting clients with growing, managing, and protecting prosperity. And we all love that. With more than 3,400 professionals across more than 25 locations, they provide expertise to public and private companies across many industries. This includes construction, real estate, professional services, not-for-profit and government healthcare, manufacturing and consumer products, food processing, agriculture, technology, and financial services. Whew, I think they cover the gamut on all of those. So to learn more about Moss Adams and their depth of expertise, please visit their website at mossadams.com. Take it away, Todd.
Thank you for the introduction, Barbara. And I would like to thank everybody for joining us on today's webcast. As Barbara mentioned, my name is Todd Kooiman, and I am the partner in charge at Moss Adams in the Bellingham location. I work on a lot of small or closely held businesses in the manufacturing, consumer products, construction, agriculture, and food processing industries. Just a few housekeeping items. As we are conducting this as a webcast, we ask that you please feel free to send any questions you have throughout the presentation to us by using the Q&A function, and we'll do our best to answer those questions as we are going through the webcast. Additionally, we are planning to have some time at the end of the presentation for any additional questions. And then finally, the Whatcom Business Alliance is also planning to send out this webcast, and they are doing a recording of it. So they will send out the slide deck following today's webcast as well. So without further ado, we will move forward here, if I can get the controls in line. And I am going to briefly turn it over here to Michelle and then ask her to introduce herself. And then we'll have Shane also introduce himself. So Michelle.
Thank you, Todd. So Michelle VanDellen, I am a tax partner in our Bellingham location as well. I work in our private clients. So I work on the owners, work on and with the owners of the businesses that Todd mentioned in various industry groups that he mentions. I do personal tax, estate and gift and trust, estate planning, and owner transition planning. And I'll pass it off to Shane.
All right, yeah, Shane Griffiths. I'm a senior manager in our state and local tax practice. Work out of the Seattle office, but serve the Bellingham office as well. Focus primarily in Washington, business occupation tax, sales tax, public utility tax. Also do a lot of work with multi-state sales and use tax and multi-state income tax.
Thanks, Michelle and Shane. In regards to our agenda today, I just wanted to give you guys a little heads up. So we are going to have a little bit of fun here in doing some speculation as to what President Biden will be proposing for tax changes coming up. I will take the first section of that and deal with some of the business side, and then I'm going to pass it over to Michelle, and she's going to deal with some of the individual proposals that are out there. She will continue on then and talk about some estate planning items that we feel like you guys should be aware of. Shane will come in and deal mainly with Washington State, some proposals that are looking at coming up here in the state of Washington, and give us kind of a reminder of some of the changes that have recently happened. And then I will again wrap it up at the end, dealing with some of the COVID relief laws that were passed recently, and just give you guys a reminder of what's going on there. So with that, we wanted to start just taking a quick look here at our state of our Congress. So as you can see, the Democratic Party has the House by 11 members, and then it's a split 50-50 for the Senate. And with that, because we have President Biden and Vice President Harris, we have a Democratic kind of sweep, if you will. So we have the Democrats are listed as that party in power. And I think we put this here mainly so that you guys remember that we are just the messengers. We are not the ones making these laws. We are not the ones that are proposing these laws. We're simply the ones informing you of that. So as the saying goes, don't shoot the messengers. Wanted to bring your attention here to 2022 re-election. And the main reason that we're looking at this one is when I've talked to a lot of different people in the industry and some of the experts out there that are familiar with where the tax law might go, many people are informing us right now that they think 2021 is going to be a fairly, I'll say, stale year for any kind of major changes. We know that they're going to make some changes, but because COVID is still pretty prevalent in what's going on today, we don't see dramatic changes coming into play in 2021. However, as you can see here, with 34 senators up for re-election, there could be a more drastic shift in the power. And at that point, 2022 might be the year where we see a lot of changes being proposed and probably a lot of changes that are going to be passed. So just wanted to bring your attention to that piece of it. As I look at those Democrat senators that are up for re-election in those states, I really don't see a lot of major changes happening with those states. I think they're going to probably get reelected. Whereas when you look at the Republican side, I can see a few of those states possibly then making a change and switching basically to Democrat. So let's move on here and have a little fun. Hopefully you guys find it fun. That's coming from a tax person, of course, who does enjoy doing his job. So bear with me in the fact that I say and I call this fun. Hopefully you guys find it very informative at the minimum. So with the 2017 Tax Cut and Jobs Act, President Trump at the time put into play a flat rate for corporations of 21%. That's on any taxable income that they might have. It went to a flat rate of 21%. As you can see here on the right-hand side, President Biden would like to increase that to a 28%. He is also instituting here kind of a new minimum tax where he, I think, is tired of the headlines where we read, you know, this major, huge corporation had book income of, we'll call it, you know, $5 billion, and yet they paid nothing in tax. So he's looking at instituting a minimum tax here of a 15% on their book income if those corporations are reporting more than 100 million of annual book income. So obviously putting in this new minimum tax, as some of my colleagues will say, the devil's always in the details, and we don't have a lot of details on these, but this would be kind of a major shift that this minimum tax for these corporations would be a pretty big deal. So along with the 21% came a new deduction, a new code section. For those of you who like code sections, this is 199 Cap A, is a qualified business income deduction. And in essence, this is eliminating that benefit for any C corporations, and it's really passing a benefit to the flow-through entities. So partnerships and S corporations, they were receiving a 20% deduction on their qualified activity, so their qualified business income. There were certain limitations with that based on how much your adjusted gross income was. There would be limitations put into play, but in essence, it was basically a 20% reduction or an additional 20% deduction against your adjusted gross income. Obviously, you can see here, President Biden would like to eliminate that and in essence, phase it out completely for any taxpayers earning more than $400,000. There's a number of our local small businesses that do not have taxable income on their net income that exceeds 400,000, but there's a number of them that also exceed 400,000. So this would be a really big impact on those flow through businesses. Hopefully you all know and understand the bonus depreciation. It has been around for a number of years. One of the major changes that happened a few years back was that it had to be new to you. When it first came out, the asset that you were buying had to be brand new. Nobody ever used it, so original use is what it was called. Then they changed that to allowing more like what we have with a Section 179 deduction, where it just has to be new to you as the taxpayer. You are still allowed then a 100% eligible deduction on that qualifying property. That was extended to 2022, and the phase out starts in 2023. As you can see on the right-hand side here, we're basically saying there's nothing specific that President Biden has come out with on this, but in general, he doesn't like the 2017 Tax Cut and Jobs Act. So any kind of benefits that are reducing taxes to corporations or others, I think he's in favor of limiting and moving those on and letting them expire. A couple areas where President Biden is coming up with some creative thoughts is he's putting in a couple new credits and proposing a couple new credits for, again, a Made in America, so a 10% tax credit for those companies that are creating American jobs and or increasing manufacturing wages. That would be, you would take and look at your pre-COVID-19 baseline, so anything greater than that, you would receive a 10% credit on. The other one there is a manufacturing credit. So if you are really renovating, remodeling, restoring any kind of an existing facility, you can also what President Biden would be talking about. And then he's really not looking to eliminate the work opportunity tax credit, and instead he would like to expand that slightly and include military spouses as the benefit. So anybody that would hire qualified military spouses would also receive this work opportunity tax credit. So he would look to also expand and make permanent the new markets tax credit that is currently available for those equity investments that are going into low-income communities. And I don't know how many people have heard today, there was a lot of noise and a lot of news around climate change, and President Biden is looking to really institute a lot of changes in this area. And so obviously it's probably no surprise for those of you who saw that he's really looking to end any kind of fossil fuel subsidies and would really like to eliminate our dependency on the fossil fuels and would like us to really explore I'll call them more green credits and more green energy sources. Then looking here at the bottom, kind of at the real estate item, I think the two biggest things in this category where President Biden is really looking to go is many people, as they are looking to grow their personal wealth, they're making investments in stocks, but they're also potentially making investments in real estate, whether that's rental real estate or just purely an investment property that they're just planning to hold for a long term. One of the ways to grow that is by turning around and maybe selling a part of that property or selling one piece of property and rolling that profit over into another property via the like-kind exchange. In this case, President Biden would like to eliminate that, so you no longer can defer that gain and continue to push it forward and roll it forward. He would look to completely eliminate that benefit. And then I think the other one that kind of jumps out at me when I was reading through all of this is really creating this new $15,000 tax credit for the first home buyers, giving them an opportunity to maybe be able to afford a house sooner, to be able to jump into getting a $15,000 tax credit that's just going to give them a benefit on their federal income tax. So at this point, I think I'm going to turn it over to Michelle, and she is going to carry us through some international and individual proposals.
Thank you, Todd. Starting with the international tax changes, these rules around the international tax regime, particularly those that came out as part of the TCJA, are very complex. So I'm covering them today with just a really broad brush, and I will, if there's follow-up questions, we'll certainly be happy to address those. So the first one on the list is what they call the GILTI, the Global Intangible Low Tax Income, GILTI, and the Base Erosion and Anti-Abuse Tax, BEAT. And these are almost the worst acronyms that you could choose, but that's what they are. And so GILTI generally, as again, a broad brush, requires current inclusion by U.S. shareholders of a foreign corporation, the income. So rather than getting a deferral on that income until the money is brought back to the U.S., the income is taxed currently. The income, there's an exemption for based on a formula, which is based on fixed assets held by the corporation, and the tax rate is about 10.5% on this GILTI income. The Biden administration would like to change the GILTI. They're keeping the GILTI rules, but they are making some changes to them. They want to look at, rather than allowing a shareholder to look at all of their foreign corporations and aggregate them together in determining whether the GILTI tax applies, they want to require that each shareholder look at the foreign corporations on a country-by-country basis, which would reduce the ability of a shareholder to offset income with losses and net those together. So it's going to create a situation where more income would likely be subject to the GILTI tax. They also want to eliminate this exemption that is out there. So the amount that's exempt from GILTI is based, as I mentioned, on a formula equal to 10% of your fixed assets that are invested in that company. And they want to eliminate that exemption and, in essence, subject all of the income of the corporation to the GILTI tax. And then they also want to double the rate, so raising the rate from 10.5% to 21%. BEAT tax, there's no changes in that, but just so you know what it is, think of it as kind of like an alternative minimum tax. It requires a calculation of modified taxable income, which adds back deductions for payments made to foreign related parties. So in essence, it's preventing a company from stripping out its US earnings and sending those overseas where they would be taxed at a lower rate. So it's a tax that requires you to add that back. And that tax is still out there and there's no changes planned for it at this time. And the last one is what we call FDII, or Foreign Derived Intangible let's see, what is it again? I lost it there. Foreign Derived Intangible Income, FDII, on and anti-inversion regulations. These are the regulations, and they would have been in the news quite a bit, about corporations moving overseas, leaving the United States and moving overseas. And these were put into place to eliminate or reduce the incentives for companies to do that. The FDII regime would go away and would be replaced by some credits. Todd already touched on these, so they impact not only just completely US businesses, but also businesses with foreign subsidiaries, and they're really incentives to just keep the jobs, keep the investment here in the United States. So it's a 10% Made in America credit to return production to the United States, revitalize manufacturing plants, and increase wages paid to manufacturing workers. And then for every carrot, there's a stick. It imposes a 10% surtax on corporations that outsource their manufacturing, and then the goods are sold back into the United States. So this would basically effectively raise the corporate tax rate to almost 31%. It's a 10% surtax on the 21%. And companies to, if there are public investments in companies, so incentives, municipalities, states provide incentives for companies for relocating to a particular area. If that company should later leave the area and close down their shop in the United States and move overseas, there would be a clawback of those public investments. So that's what we've got on the international side. And now let's move on to the individuals. So with the individuals, the first one up is 37% tax rate. So that's our current top tax rate. That has been the case since 2018. It was set to expire after 2025. Prior to 2018, it was the top marginal tax rate is 39.6%. And as Todd mentioned, the Biden administration does not like the TCJA, and they would like to roll back a lot of those provisions, particularly with respect to high income taxpayers and high income for this purpose. And you'll see this number popping up over and over again is $400,000. So that's sort of the threshold at which the income taxes generally are going to increase. And President Joe Biden, during his campaign, did say that he would not raise taxes on individuals making below $400,000. And with one exception that I've noted as we go through the presentation, all of these proposals actually do adhere to that. So the capital gains tax rate. Right now, the top rate is 20%, has been for many years. Additionally, there is a 3.8% net investment income tax for income over, let's just say, $250,000 for married filing jointly. The proposed capital gains tax rate proposes to tax capital gains and qualified dividends for taxpayers with income over $1 million. So, and those would be taxed at ordinary rates rather than the long-term capital gain rates. And so, for example, and still subject to the net investment income tax. So if you're looking at, if your income is over $1 million, any gains or qualified dividends above that will be taxed at basically 43.4%, 39.6 plus the 3.8% net investment income tax. And in a few minutes, Shane is going to talk about a possible, I believe it's 9% Washington state tax on capital gains. So now you're looking at a tax rate well over 50% on these capital gains. And the question is, well, is it all capital gains? Is it only capital gains above $1 million? It's really, they throw all your income into a pot and they look at all your income. So if you have, for example, $800,000 of wages and $500,000 of capital gains, your total income is 1.3, and the $300,000 would be subject to the ordinary income treatment for the long-term capital gains. That is a theory it is logical with how similar provisions, for example, the net investment income tax is applied. You would pile that capital gain income on top of your other income to determine how much is subject to the ordinary tax rate. Now, the good thing is that if you do have to pay that 9% Washington state tax on the capital gains, you have a greater likelihood of being able to deduct it under the president's proposed tax plan. So right now, the current law standard deduction for married filing jointly is almost $25,000, expires again after 2025. The big limitation currently is the limitation for state and local income tax deductions. So right now that is capped at $10,000, and the proposal is to eliminate that cap on the deduction for state and local income taxes, which will be welcomed by those of us on the West Coast and the East Coast. So you will have a better likelihood of deducting your state real property, personal property, and any income tax that you may have. However, to describe it, the benefit of the deductions will be limited to 28%. So even though you may be in a 40% or 39.6% tax bracket, the value that your itemized deductions will be calculated such that the tax benefit is capped at 28%. So it won't be a dollar for dollar reduction. Said another way, your itemized deductions are not going to be worth as much as deductions as, say, business deductions or other what we call above the line deductions. In addition, those of you who have been subject to this before may remember what is called the Pease limitation, which is named after the lawmaker who originally proposed it. Above certain thresholds, your itemized deductions do start to phase out. So even if you're in a 43.4% tax bracket, again, the benefit is going to be limited to 28% and then further phased out from that. Now, there is a section here on the state taxes, which I'll cover very briefly, although we are going to cover it in more detail later. The biggest changes are the exemption per person. So the lifetime exemption of property that you could give away via gift or through your estate is almost 11.6 million. That was originally scheduled to revert to a pre-TCJA amount of 5 million indexed for inflation, which we figure now it would be just kind of, we've been using 7 million after 2025. However, that is one of the proposals is to reduce that 11.6 million down to 3.5 million of exemption, which dramatically changes the estate tax situation, the estate tax picture for most middle income and moderately wealthy families. The other significant change is the transfer of appreciated property. For those of you who have inherited property or helped family members with estates, you probably are familiar with the fact that when someone passes away, assets that they owned at the time they passed away get what's called a basis step up, which means for purposes of the individual inheriting the property, their base tax basis is its fair market value at the time the individual passed away. So if I inherit property from my father and it is worth $1 million at the time I inherit it, and I hold on to it for a few years and I sell it for $1,300,000, my gain is based on just the $300,000 of appreciation since the period of time that I inherited it. That is a significant tax benefit to heirs. It's a significant tax benefit in the passing over of small businesses, closely held businesses. And there is a proposal to actually eliminate that basis step up. And we'll talk about that a little bit more in a later slide. But we can move on now to a few other individual taxes. Okay, so the qualified opportunity funds. These were enacted as part of the CARES Act, and you may have heard of them. They did get a lot of press when they first were introduced, and a lot of people took advantage of them. You were able to shelter and defer the payment of the tax on gain from certain sales or exchanges, qualifying sales or exchanges of property, by taking those proceeds and investing the gain into a qualified opportunity zone fund. Further, as the money was invested in the fund, if the money was left in the fund, there was the opportunity to earn some tax-exempt gain on appreciation within the fund if you met certain holding period requirements. Under the President Biden's proposals, the qualified opportunity zone funds are still available. They're still out there. However, there was a fair amount of criticism that they weren't really providing the anticipated benefits to the community. The trade-off for allowing an individual to defer tax on gain or escape taxation on appreciation was that the benefits to the community within the zone that the investments were being made would be a worthwhile investment of those funds. And there's been criticism that they're not. So President Biden is looking to reform the rules to focus on really the community side of this, creating jobs, development for low-income communities, partnering with not-for-profits and community organizations, and really kind of providing some transparency on investments to just make sure that the American taxpayer is getting what they're paying for. So another really great provision for, again, middle income and lower income families is the child care and dependent care credit. Increase of that from the $3,000 to the $8,000, and it is $16,000 for more than one individual, or sorry, for more than one child. Okay, moving on to the next slide, student loans and education. There's a lot here in terms of student loans, a lot of talk about loan forgiveness. So there's pretty much three kind of proposals. One is that you see talks about a repayment plan for 20 years. So if a loan is repaid, if you make payments on the loan, which is 5% of your income for 20 years, the balance of the loan will be forgiven. Also, if you offer, if you are allowed to have $10,000 of loan forgiveness per year, up to $50,000, if the up to $50,000 if you work in a national or community services, for example, you're teaching or other community service areas, you can get up to $10,000 forgiven per year. The child tax credit has become much more generous, going from $2,000 to $3,000 for children, an extra $600 for those children under 6, and it's fully refundable. Moving on to the next slide. Other tax provisions, the payroll tax. For those of you who've been around a long time, you probably remember this is referred to as the donut hole. So if you pay Social Security tax as an employee or as a self-employed individual, the Social Security, what we call the FICA tax, was capped at about $138,000, and that was it. You had paid your Social Security tax. There is now a resurgence of that tax, so you will pay the Social Security tax up to your wages of $138,000. Then you will not pay Social Security tax on wages until you hit $400,000 for the year, and then you will start to pay that Social Security tax again. So again, it's just a tax designed for and targeting high-income individuals. Retirement incentives help small businesses cover the cost of setting up 401k plans, looking at actually replacing the deduction for contributions to 401k plans and IRAs. Rather than having them be deductible, giving a tax credit up to 26% of the amount contributed. So this is designed to sort of level the playing field between high income earners and low income earners by giving a tax credit rather than a tax deduction So it favors the lower income individuals who don't benefit from the tax deduction. On to the next slide, healthcare and long-term care. Really here, it's just expanding the availability of individuals to purchase insurance on the exchange and qualify for the premium tax credit. So again, just making it more available and more individuals eligible to take advantage of that program. Okay, estate planning. So I talked about the elimination of the step up in basis going from 11.6 million, or sorry, the elimination of the step up in basis as well as the reduction of the lifetime exemption going from 11.6 million down to 3.5 million. So looking to also reinstate the 2009 estate tax rate of 45%, and they're actually looking at a graduated rate of 45 to 65%. So estate taxes are going up. So moving on to Washington estate tax, there's only one change here. I did just want to remind you of the Washington estate tax. A couple things. There's no portability in Washington state. So for at a federal level, a married couple is allowed to, if one individual passes away, the other spouse inherits that exemption amount. So they get to add to their own exemption whatever their deceased spouse did not use. That is not available in Washington state. So planning and proper estate planning for Washington state is critical because you can't rely on the portability. The filing threshold is almost 2.2 million, gross estate of 2.2 million you need to file, and that's gross estate, not netted for liabilities. Applicable exclusion amount, so you can have about 2.2 million in property before you start paying any Washington estate tax. And the estate tax starts at 10% and gradually increases to 20% for taxable estates over $9 million. One thing I wanted to mention was estate tax treatment of real property owned by business entities. This was a change in 2020. And basically, if it's a change in the definition of intangible property. So if you have property outside of the state of Washington and it's held in an LLC or a corporation, real property, it will be brought back, considered intangible and brought back to the state of domicile. So estate planning opportunities, a few things to consider. The lifetime exemption amount, again, if you've got an estate somewhere between $3.5 and $11.5 million, may want to look at doing some gifting or some estate planning to try to get closer to the $3.5 million if it looks like that proposal may pass. There's also a couple of different kinds of trusts, which are called GRATs. Grantor retained annuity trusts. These are trusts that allow you to make a gift and then retain an annuity back. So you can make a gift of property and retain an income stream. And again, that would allow you to reduce your estate, but retain some income to cover your retirement needs. Sales to intentionally defective grantor trusts, again, another unfortunately named provision called an IDGIT. So what these are is they're very powerful estate planning tools. And if you need to move a lot of assets value to your heirs quickly within a short period of time, they take advantage of some nuances between the income and estate tax laws and allow you to do some really creative and significant estate planning. And then the last, of course, is discounting, lack of marketability and minority interest. Small businesses are, obviously you have to account for the fact that there are few owners and you may not have voting control. There's not necessarily a market for a business. So we want to take advantage of discounting and making gifts because discounting is one of those things that may not survive and may actually be eliminated in a future estate tax proposal. So with that, I will turn it over to Shane.
Before we jump over to Shane, sorry, Shane, I'm going to jump in here a minute. There was a quick question here, Michelle, on Washington estate tax exemptions. So does the state have any plans to update the CPI index that was tied to the Washington state exemption amount, and again, allow for exemption amounts to rise with inflation?
No, not that I'm aware of. And I would say unlikely because you know, as all the states are, they're revenue hungry. So I would not see them anxious to make that change.
Thank you. All right, Shane.
All right, thanks, Todd. Thanks, Michelle. I'm going to start by covering a few pieces of proposed legislation at the Washington state level. The first is the capital gains tax. So this is kind of you know, the revenue centerpiece of Jay Inslee's proposed budget. There is a bill. It'll likely be introduced as part of the next legislative session. You know, we've had several iterations over the years of capital gains tax. It hasn't been successfully passed yet. This is kind of another attempt, but in its current form, it's a 9% tax, as Michelle said, on the sale of stocks and bonds and other assets. So this does have the potential to apply to more than just, you know, what you have maybe in the stock market or, you know, traditional types of investments. You know, could potentially apply to the sale of your business, the sale of non-residential real estate. So it could have some pretty broad implications if passed. There's also a relatively low income threshold. So it would apply to capital gains over $25,000 for individuals and $50,000 for joint filers. And there are exemptions. So there's exemptions for retirement accounts, homes, farms, certain forestry land. And then the proposed legislation also confirms that salaries and wages are not capital gains. And so, you know, always, I think, a lot of speculation when we have proposed legislation on capital gains. You know, will this lead to a broader kind of state income tax? You know, I think it's yet to be seen if that will happen. I think there's a number of hurdles to get this passed, and to, you know, I think it's reasonable to expect that if it is passed, there will probably be some legal challenges in the courts. And this next piece of proposed legislation relates to government grants. And so this would make more clear the types of government grants that are exempt from Washington business occupation tax, public utility tax, retail sales tax. Currently, there isn't anything specific on like COVID-19 relief. What this would essentially do is exempt any government grant programs that are tied to a national or state emergency, including COVID-19. Currently in Washington, there's kind of informal guidance from the Washington DOR that if you're receiving some sort of financial assistance from a federal program, including the paycheck or the paycheck protection program, that you shouldn't pay tax on those amounts right now. But they've also reserved the right to go back and reverse course and tax those amounts, depending on how the legislature weighs in on these issues. So this is legislature acting, and it seems to be trending in the right direction that there'd be an exemption that'd be clearly carved out for those types of programs. And this third piece of kind of proposed was in Governor Inslee's proposed budget related to bad debts. This probably has fairly limited application, but if you see it out there, just for some background on it, it is really kind of in response to a Washington Supreme Court case called Lowe's Home Centers. It was a situation where Lowe's had contracted with banks to provide private label credit cards to Lowe's customers. Lowe's customers would make a purchase. The banks would forward the payment and any sales tax that was collected to Lowe's to then remit on their Washington returns. But part of this arrangement was that Lowe's would reimburse the banks for a certain percentage of their losses, and they paid this fee. And Lowe's took the position in a refund claim with the DOR that they could deduct those reimbursement payments for losses sustained by a third party. They could take those as a bad debt deduction. DOR disagreed. They ran up the court system, and the Washington Supreme Court essentially ruled in favor of Lowe's, and so it was a taxpayer win. And so this is really driving at that type of fact pattern to limit the ability to take that bad debt deduction going forward. So those were the kind of three proposed piece of legislation we wanted to highlight. Also wanted to just do a recap of some 2020 changes. it was a busy year for a lot of reasons, but there were a number of pretty significant changes at the Washington state level. One related to the service and other tax classification. They tacked on a 0.25% surcharge on the 1.5% rate. And so if you're reporting service income in Washington, you're potentially subject to that 1.75% rate if your service income in the state is $1 million or more. There are exceptions. So if you're a real estate broker, you have commission income, you're still subject to the flat 1.5%, regardless of what your service income is. And there's also an exemption for hospitals where they would be subject to the 1.5%. Washington also reduced its economic nexus threshold, and this is probably a little bit more relevant for out-of-state businesses looking to determine whether or not they should file a Washington return. But it can also, I'll get to in a minute, it could be relevant for in-state taxpayers as well. It was reduced from a $285,000 threshold to a $100,000 threshold, and then simplified in that it applies really to any kind of activity into the state. So if you're a wholesaler, you're a retailer, you're a service provider, if you have $100,000 or more of receipts sourced to Washington state, they want you to file a Washington tax return. But if you're a service provider in the state, this change can potentially make it easier for you to take a deduction for services provided to customers either outside of Washington state, or maybe it's a customer that's in Washington state, but your services relate to your customer's activities outside of Washington. So this change and this reduction in the nexus threshold may make it easier to take that deduction, reduce your tax liability for in-state taxpayers. Another increase in tax rates was for the real estate excise tax. So this is the tax you pay anytime you sell a property, so a deeded transfer of real estate, or if you sell ownership in an entity that owns real estate excise tax can apply if that ownership change is 50% or more. So the state rate used to be a flat 1.28%. It's now kind of a graduated rate schedule from 1.1% up to $500,000 of a value or selling price. It ranges up to 3% for if the selling price is above $3 million. So it's one of the higher, I think, kind of real estate transfer taxes in the country once you get into that 3% tax bracket. Another important change that they made was with respect to those controlling interest transfers. So again, this is situations where you're not necessarily selling real estate itself, but you're selling an entity that owns real estate. Prior to this change in 2020, you were required to look back 12 months to aggregate any of your transfers in that 12-month period. And if you add those together, it met that 50% test. It would trigger REIT on the entire value or selling price of that real estate. It's now been extended. So the look back period is 36 months instead of 12. So it's a longer look back period you have to consider when determining whether or not you triggered this controlling interest transfer. Another important reporting element to this is that anytime you transfer 1/6 or more of an entity that owns real estate, you're supposed to report that transfer to Washington state. If you don't report that transfer, it's just kind of an informational report, and it's later determined that you had a controlling interest transfer, there's a 50% evasion penalty that can apply to that transfer, and 50% of the tax that's due. So it reporting requirement, but if you miss it, it could end up costing you in penalties. And then just wanted to highlight briefly, City of Seattle, they have a payroll tax. It's only applies to businesses with $7 million of payroll in the city, but the first return will be due January 2022 for the 2021 calendar year. And then this final kind of state and local tax slide, just wanted to kind of highlight Wayfair and economic nexus for sales tax. This has been out now for a couple of years, but it's just this idea that states are now requiring remote sellers to collect and remit sales taxes, even if the remote seller doesn't have a physical presence in the state. And it used to be prior to Wayfair that without that physical presence in the state, you didn't have to collect and remit sales tax. Now it's sufficient if you exceed these thresholds or these tests. One is generally a sales threshold. It kind of rule of thumb, it's $100,000, or a transaction threshold, 200 transactions. And so we're getting to the point where we're several years into this. states are becoming more aggressive in reaching out and contacting out-of-state businesses that they think should be complying. And so it's good to, kind of check on your sales, take a look and kind of do a risk assessment on, where do you exceed $100,000? Do you have some risk for uncollected sales tax liabilities?
Shane, there was a question thrown out that, do we have an anticipated timeline of some of these proposed taxes that Governor Inslee is putting out? Is there a guess? Is that a 2021, or does it really have to go through legislation to more likely be a 2022 if it would pass?
I think the earliest, like the capital gains tax, for example, it would go into the legislative session, I think like in this April. So I think the earliest it would go into effect would be January 1 of 2022. But I think that would also, if there's litigation, that might also potentially put it on hold from actually being, in effect. So there's a couple kind of hurdles that the tax would have to get through to be effective.
Excellent, thanks. All right, with that, buckle up. We're going to try and get through a couple of these slides here pretty quickly because I know we're coming toward the end. By all means, please continue to submit your questions if you have any, and I will try to make sure I'm watching for those. But let's go over a couple other things that we saw really impact us in 2020. First thing was we got a little Christmas gift, I'll say, at the end of the year. As you see on that first bullet point, for a long time, any of the Paycheck Protection Program loans that you took, the Congress set that up first to say this was going to be deductible and not taxed if you got the loan forgiven. And then the IRS came out with information telling us that the actual expenses that were used, or that the proceeds were used for, were non-deductible. And we actually found out that they came back and said, nope, these are deductible. And so we can now deduct those. So I'm sure many of you who have taken those loans are probably going through the process of getting them approved for forgiveness. And so there is some additional safe harbor rules that I'm not going to cover today, that if you haven't received forgiveness in 2020, but you anticipate receiving it in 2021, so there are some safe harbors around some of those unique situations. Feel free to reach out if you need to. Happy to answer those and go on. So looking at, I just have the California one up here just to let you guys know that in this case, California does not conform with the federal law. So if you are operating in multi-states, make sure you understand the applicable state law where you are operating and find out, and that's the whole point of plan accordingly. This is basically talking about the form that the SBA is looking for, the documentation as to your good faith certification as to why you saw that there was an economic uncertainty, and make sure that you're filing these in accordance with when you received it. There's typically a 10-month window that you're supposed to look at. Then round 2 of the PPP loan. So obviously, quickly read through these here. You have to have less than 300 employees. A big one here is that you've experienced a revenue reduction. And you can look at this on a quarter-by-quarter basis. So you can compare second quarter of 2019 versus second quarter of 2020. And if you had a greater than or a 25% or greater reduction in the revenue, you would qualify. Again, you can see that these are capped at 2 million and that it is 2.5 times payroll for most businesses, except for if you're in the food and accommodations, then it's 3.5 times. The biggest thing here with the employer retention credit is that it was extended. So you have until June 30 of 2021. Again, you can see here that you can get up to a $14,000 credit per employee for the first 2 quarters in 2021. You must have a 20% decline in gross receipts on a quarter-by-quarter comparative. The big news here is that previously the CARES Act had restricted this, so you could not have the PPP loan and take the employer retention credit. They eliminated that restriction. And so now you can do both of those. And so we really feel like that's a huge benefit to the taxpayer. Here were some extenders. Again, I'm going to go through this pretty quickly. Feel free to reach out if you guys have any other questions. And again, this is all going to be provided to you in the slide deck. I think the biggest items of note here are the last 2 bullet points, where you get 100% deduction for your business meals, including delivery and carryout for all of 2021 and all of 2022. And then also that you have the extension of the sick leave and family paid leave through the first quarter of 2021. Some additional extenders that get us out to 2025, the new markets tax credit, the work opportunity tax credit, those are the biggest ones there that are being extended through 2025. If you look here, the extension of items through 2021, I think the biggest one here is the first bullet that most people would be interested in. And maybe the second bullet point, again, the mortgage interest premiums qualifying as residential interest, or the health insurance costs, getting a credit for those. And then probably the last one as well, just the extension of the residential credits for efficiencies. Some other quick notes that were corrected is a qualified improvement property. The original TCJA eliminated or had an error that was making these qualified improvement properties not eligible for bonus depreciation. That was corrected to allow for the 15-year property to qualify for bonus. It is retroactive back to 2018, so make sure you're reviewing your depreciation schedules and taking a look for that to maximize any kind of benefit that you might have there. There was also a huge limitation on net operating losses. And so if you had a net operating loss for your business or as an individual, there was no longer a carryback, that it was eliminated. This was corrected or now extended so that you have a 5-year carryback for all of those losses incurred in 18, 19, or 20. And then also the big one here is that the 80% limitation has been eliminated or removed for those net operating losses that were incurred in 18, 19, and 20. So you do not have a limitation. You can utilize 100% of those net operating losses. You have a deferral on your payment for payroll tax. This is the employer portion. So you can defer any of those that were originally due, basically from March 27th through the rest of 2020. You can defer those payments to pay 50% on the last day of 2021 and the last day of 2022. A little nuance here that you have to kind of watch is the deductibility of those. And so I'm just going to say, feel free to reach out to me. I'm happy to have a conversation with you about the timing of that and how that impacts exactly the deductibility there. So if you have questions, let me know. And then the last one here that we're really looking at is they came out with a new code section again. It's 163J. It was limiting the interest expense based on your activity. It limited to 30% of the adjusted taxable income that you did on a calculation. The CARES Act actually increased that percentage to 50%. So 50% is the new one for tax years in 19 and 20. Are there any questions that anybody would like to unmute themselves and let us know?
Todd, there was a question about if President Biden's proposals, when might they go into effect? And you had responded, and I'll just share with the group that at this point, just remember, none of these have even been proposed in a tax act yet. So they still have to be, go through Congress, go through the committees, negotiated upon. And that's going to take some time. The general school of thought, as you mentioned earlier in the presentation, is that there are a lot of priorities at the moment. Dealing with COVID is obviously at the top of the list, among a few other things. So we're not sure when in 21 or even if within 21 we'll see these passed. So Generally, the laws are effective when passed. Although if it gets really close to the end of the year, they would probably make them effective, 1/1 of 22.
Yeah, and I see there was another question in the chat on the $2 million limit for the PPP loans, if that is based on an entity by entity. So if you have multiple entities and they're maybe all related by individuals or in other ways, is that looked at as a single entity, or are they aggregating it all and looking at the full group? And generally, it's going to look at the entire group there. So you're going to be looking at basically related party rules apply in all of that. And so they're going to tie everybody together and say, all of these are one big company. And so you're going to look at that from an aggregated piece. Michelle or Shane, do you have anything else that you want to add to that?
No. Great question from Matt. If the tax is passed within the calendar year, do they typically go retroactive to the first of the year? That is possible. It has happened. That's something to be a bit concerned about. Generally, though, Congress has been reluctant to retroactively pass tax laws that raise tax rates, particularly on individuals. They're more likely to raise tax rates on companies because companies don't necessarily vote, but they're reluctant to go back and raise taxes retroactively on individuals. So it is possible. The farther we get into the year before Congress addresses tax law, the less likely it is to be made retroactive. Had they had a tax law ready to go immediately following the inauguration, we would be more likely to see it retroactive. You get out to June, July, August, that's going to become less and less likely.
Thank you for the questions. Those were great. Again, I want to thank everybody for joining us on this webcast today. Greatly appreciate it. And just a reminder that our WBA friends will be sending out an email of the recording of the webcast and the presentation deck. If you guys have any questions, please feel free to reach out to myself, to Shane, to Michelle. We're happy to answer any of those questions that you guys might have. And at this point, I think I'm going to hand it back over to Barbara. Thanks.
Wow, that was a lot of valuable information today, you guys. Thank you so much for our presenters from Moss Adams, Todd, Michelle, and Shane for being with us today and giving us all a look into what 2021 looks like with the Biden administration. And again, this webinar will be available on our website soon if you missed a portion or want to revisit the discussion or tell your friends that weren't able to attend. They can revisit that on our website. But wait, there's more. All the participants who did register on the WBA website for this webinar will receive today's slide presentation via email as well. So thank you, everybody at the WBA. We know our advocacy efforts are strongest when supported by the real voices of business, all of you. We'd be excited to add your company to our list of outstanding members of the WBA. So look at our website, whatcanbusinessalliance.com, and join us for our upcoming events. We have our economic forecast breakfast scheduled for February 25th at 8 a.m. That is going to be a virtual event due to the lockdown restrictions starting at 8 a.m. Look on our website, go ahead and register. You don't want to miss our expert economists presenting the 2021 outlook. And to learn more about Moss Adams and their depth of expertise, visit their website at mossadams.com. So thank you all for participating today. Watch for our upcoming series of Recovery Whatcom webinars. Stay safe and goodbye for now.